The year is 2015. Tokyo. Inside the gleaming, imposing headquarters of Toshiba Corporation, something is fundamentally broken. This is not the story of a sudden market crash, but of an insidious, slow-motion implosion years in the making. We open not at the beginning, but at the abyss. Imagine a company that, for nearly a century, defined Japanese engineering prowess. They gave the world the laptop, the CD, and the foundation of modern semiconductor technology. Their brand was synonymous with reliability, precision, and the very future of technology. Then, the truth leaks out. Not a trickle, but a flood. On a tense Tuesday morning in July 2015, the facade shatters. CEO Norio Sasaki, a man whose career was built on the bedrock of Toshiba's reputation, is forced to stand before the press, head bowed, unable to mask the sheer scale of the deception. The number isn't small. It's not a rounding error. It's a black hole of approximately 151.8 billion yen. At the time, nearly $1.2 billion USD. That has been systematically hidden within the company's books for years. This single revelation was the starting gun for a decade-long descent into chaos, eventually ballooning into a staggering $18 billion crisis. How does a global powerhouse, a company deeply ingrained in the fabric of Japan's post-war miracle, not just fail, but actively self-destruct? This isn't just about faulty accounting. It's a story of hubris, cultural pressure, and the catastrophic consequences when ambition completely outpaces integrity. The dominoes were already falling, we just hadn't heard the sound yet. What seismic forces truly drove Toshiba to risk collapse, and could anyone stop the slide once it began? From which they fell? Pause for dramatic effect. Because the $1.2 billion lie by the mid-20th century, $18 billion implosion, a merger of Tokyo Shibora Electric, was not just a company. It was a symbol of Japan's technological renaissance. They were the titans of monozukuri, the Japanese art of making things with pride and unparalleled quality. By the 1980s, Toshiba was ubiquitous. You saw their name on VCRs, televisions, and revolutionary innovations like the world's first consumer laptop, the Dynabook, introduced in 1985. They were global behemoths, generating revenues exceeding $50 billion annually at their peak, employing hundreds of thousands worldwide, and operating across infrastructure, energy, medical devices, and most critically, semiconductors. Their leadership was revered, operating under the assumption of unassailable corporate strength. Key figures like Atsutoshi Nishida, who later served as chairman, embodied this era of unwavering confidence. But this confidence bred a dangerous complacency. Beneath the polished veneer of their corporate profile, a toxic culture was silently festering. This culture, rooted deeply in Japanese corporate norms, demanded absolute conformity and prioritized the maintenance of perceived harmony above all else. Whistleblowers were virtually non-existent, and internal dissent was ruthlessly suppressed. The pressure to meet relentless targets, often set by external market pressures and internal managerial arrogance, began to warp reality. The company's strategic pivot in the 2000s, focusing heavily on infrastructure projects and particularly their nuclear energy division, Westinghouse Electric, introduced variables far more complex and risk-prone than their traditional electronics business. These highly capital-intensive, multi-year ventures demanded massive upfront investment and carried equally massive potential for cost overruns. It was in managing the perception of these gargantuan projects that the need for deception, and the eventual, catastrophic accounting fraud, found fertile ground. The seeds of the collapse were sown not in a sudden bad investment, but in a systemic failure of governance stretching back over a decade, orchestrated by leaders who believed they were too big to fail. Is inextricably linked to Japan's storied bubble economy was actually built on a foundation of technology race, waiting for the first tremor to expose the rot within the structure. Toshiba became a key player in reconstructing Japan. That tremor arrived sooner than anyone expected, as an industrial exposing a hidden rot that would consume nearly 2 decades of their corporate history. By the 1970s and 80s, they weren't just manufacturing components, they were defining them. A critical area of success was semiconductors. Toshiba was a pioneering force in NAND flash memory, a technology we now rely on for every smartphone, SSD, and USB drive. This division was an absolute cash cow, generating billions in revenue and positioning Toshiba as a vital link in the global tech supply chain, often competing fiercely but successfully against giants like Samsung and Intel. Their investments were aggressive and visionary. They poured capital into research and development, often ahead of their competitors, ensuring they stayed on the cutting edge. Think of their dominance in nuclear energy, where they became a global leader, securing major contracts across Asia and the United States, often viewed as the gold standard for safety and engineering excellence, especially through their subsidiary Westinghouse. This period saw unprecedented growth, transforming the company into a sprawling conglomerate, a keiretsu spanning industries from medical imaging, where they held significant market share, to elevators and complex infrastructure systems. Executives during this zenith, like the aforementioned Nishida, were celebrated as masters of strategic expansion, guiding the company toward ever-increasing revenues, consistently exceeding $60 billion in annual sales throughout the early 2000s. This success fostered an environment where aggressive performance metrics became the unwritten law of the land. The market rewarded growth, and Toshiba consistently delivered the asterisk appearance of growth. Internal reporting, however, started showing early signs of strain, as they acquired more complex businesses, particularly the US-based Westinghouse in 2006 for approximately $5.4 billion. Integrating those massive cost structures became incredibly challenging. Yet, the cultural expectation, hammered down from the top, was simple. You meet your targets, no matter what. The company's structure made it difficult for subsidiaries to report losses transparently, fearing repercussions or the shelving of their pet projects. This created silos where significant cracks appeared not in the consumer electronics sector, rather than which was already facing fierce competition from South Korea and China, but in the complex, while Toshiba weathered the storm better than many infrastructure. The pressure to reclaim lost Westinghouse accelerated the problematic behaviors that were already simmering beneath the surface. Was intended to be Toshiba's gateway to massive, long-term energy years became the chains that would eventually choke the organization. Instead, it became the primary financial black hole. Staggering success U.S. nuclear industry, inflated particularly regulatory environment surrounding new reactor builds, setting the stage for a monumental more complex and costly than anticipated. Because the foundations laid during their golden age were about to reveal on several key fatal flaws, especially those in Georgia and South Carolina, were exponentially higher than publicly stated. Management, terrified of admitting failure on such a flagship acquisition, allegedly instituted creative accounting practices to smooth out the volatile earnings reports. This wasn't just ignoring a small loss. It was actively massaging the future liabilities of multi-billion-dollar construction projects to make them appear profitable now. The pressure cooker environment meant that division heads were incentivized to hide problems. If a division missed its internal performance target, it could signal weakness, potentially leading to budget cuts or leadership changes. To avoid this, executives reportedly engaged in systematic earnings management, deliberately understating expected losses on long-term projects or overstating current revenues to meet consensus estimates. Atsutoshi Nishida, who was chairman during some of these questionable years, and later CEO, was reportedly aware, or at least willfully blind, to the growing pressure tactics. Internal memos and later investigations suggested that a deep-seated groupthink prevented anyone lower down the chain from reporting accurate, dire assessments upwards. If you projected a loss of $500 million on a nuclear project, your peers and superiors would demand you reproject it as a smaller, manageable loss, perhaps $50 million, with the promise that you'd make it up next quarter. This created an artificial reality, a phantom profit margin used to satisfy analysts and maintain stock price. By the time the new CEO, Masashi Muramachi, took over in 2015 amidst turbulence, he inherited a ticking time bomb where the stated profits of the previous 7 years were built on sand, mostly derived from these concealed Westinghouse liabilities. This systematic manipulation meant that when the truth finally emerged, the hole wasn't $1.2 billion. It was orders of magnitude deeper. The implosion was not singular. It was a sequence of accelerating disasters triggered by the July 2015 revelation of the almost invisible $1 billion infecting Japan's biggest industrial giants. The immediate aftermath saw stock prices plummet, erasing billions in market capitalization overnight. All-consuming but the real devastation was the loss of trust. Investors, regulators, and partners realized that if Toshiba could lie about $1.2 billion, what else were they hiding? The external investigation, commissioned by Toshiba itself, unearthed a corporate culture where systematically inflating earnings was the norm. This wasn't isolated to one division. It spanned infrastructure, semiconductor fabrication, and even the memory chip division, allegedly involving collusion between various business units eager to meet targets handed down from the executive suite. The investigation revealed that executives were allegedly pressured to cook the books for periods stretching back to 2008. The initial $1.2 billion figure ballooned rapidly as auditors dug deeper into the Westinghouse nuclear business. The final reckoning for Westinghouse arrived in early 2017. Toshiba was forced to take a colossal write-down, exceeding $6.3 billion, as they admitted that the cost overruns and regulatory hurdles on U.S. nuclear projects were insurmountable. This single write-off nearly wiped out the company's equity. In a desperate attempt to survive, Toshiba announced it would sell off its crown jewel, Toshiba Memory, the NAND flash division, the very division that had sustained the company for decades. This asset, valued by analysts at upwards of $18 billion, became the sacrificial lamb. In a rushed, tumultuous auction, the controlling stake was sold in 2018 to a consortium led by Bain Capital for approximately $18 billion. This sale, while providing the immediate liquidity necessary to avoid bankruptcy, was viewed by many in Japan as a national tragedy. The selling off of a crown technological asset to foreign interests to cover internal managerial failures. The fallout continued relentlessly. The U.S. Department of Justice and securities regulators launched probes into the accounting practices, leading to significant fines. In 2017, the Tokyo Stock Exchange demoted Toshiba to Securities Under Supervision, a terrifying designation reserved for companies on the brink of delisting. Former leaders faced intense scrutiny. Former CEO Norio Sasaki, along with his predecessor Norio Hisamoto, were forced to issue public apologies, acknowledging their failure to stem the tide of malpractice. The company's brand equity, once almost priceless, was shattered. By 2020, the fire sale continued. Toshiba sold its memory chip manufacturing equipment manufacturer, New Flare Technology, and later its semiconductor testing firm, a clear indication that the core business operations were being dismantled piece by piece simply to service the debt and pay the penalties arising from the years of misrepresentation. The company that once built the future was now cannibalizing itself to survive the past. How could a corporation of such historical significance fail to grasp the simple concept of consequence, and what remains of the empire after the creditors have taken their share? Dramatic musical swell. The remaining fragments of Toshiba would soon face an even more existential threat: hostile takeovers. The aftermath of Toshiba's implosion is a cautionary tale whispered in boardrooms globally, a testament to the fragility of perceived corporate strength. The sale of the memory division for $18 billion saved the parent company from insolvency, but it came at the cost of its most valuable strategic asset. Toshiba was fundamentally hollowed out. What remained was a fragmented collection of businesses, power systems, electronic devices, and infrastructure services, all struggling under the weight of a tarnished reputation and a drastically reduced capital base. The leadership attempted a massive restructuring under CEO Nobuaki Kurumatani, who aimed to restore profitability and exit the troubled nuclear sector entirely, eventually spinning off Westinghouse out of bankruptcy protection separately. Kurumatani's tenure, however, was fraught with controversy, including allegations of mismanagement and aggressive tactics used to push through unpopular restructuring plans, further highlighting the ingrained authoritarian tendencies within the remaining structure. By 2021, the revolving door of leadership continued, illustrating a profound lack of stability at the top. The final chapter in this saga of self-destruction began when activist investors, who had bought significant stakes during the fire sale, initiated a brutal proxy battle to force a fundamental overhaul. In 2023, investor Elliott Management and others exerted enormous pressure, arguing that the remaining Toshiba conglomerate was undervalued and poorly managed, demanding a full breakup of the company into three separate entities: infrastructure, electronics, and semiconductor equipment. This move signaled the final admission: The integrated conglomerate model that defined Toshiba's glory days was unsustainable. In late 2023, a consortium led by Japan Industrial Partners, HYBE, reportedly backed by Japanese government funds seeking to keep strategic assets within Japanese hands, launched a massive 2 trillion yen, approximately $13.5 billion, privatization offer. This offer, accepted by management, aimed to take Toshiba private, delisting it from the Tokyo Stock Exchange, effectively ending its long, tumultuous tenure as a publicly traded symbol of Japanese might. The final lesson is stark. Culture eats strategy for breakfast, lunch, and dinner. The pressure to hide losses, born from a fear of admitting failure, led directly to systemic fraud that cost shareholders tens of billions, forced the sale of its most innovative division, and ultimately resulted in the dissolution of the conglomerate structure itself. When the dust settles, what remains of the legendary Toshiba name is a shadow of its former self, a collection of disparate units attempting to survive outside the glare of the public market. Was the privatization the final, necessary act of surrender, or merely a quiet retreat before the final curtain falls on the entire brand? Final, dramatic chord.